and Strategist, Institutional Equities at Emkay Global joining us today. Seshadri, it's great to have you on the program. Welcome to Money Control, and it's so good that you could make it today. So it's a good time to be asking you this question. I mean, from the top of my head, I think probably 7 out of 10 earnings that I read through this season, they were above estimates. But you tell me, I mean, you have the more accurate numbers, the pace of beats or the pace of upgrades. And while that makes us feel very good, the question really is, what will the real print in Q1, Q2 show up? Because that's when the impact of oil prices will start coming in, right?
Yes, absolutely right. In fact, even in our preview, we had said that this would be a reasonably strong quarter for numbers. And broadly, that's the way it's panning out. But beyond the point, that doesn't matter because the real pain of the Middle East conflict will be felt in the first quarter and to some extent the second quarter. But be that as it may, you're right, it has been a fairly strong number. The other thing that you alluded to, and I think that's important, is that Nifty earnings has largely held up through this period. We are still in a situation where the implied EPS growth for Nifty for FY27 is at about 12-13%, is at about 13%. There were a lot of worry that number could get downgraded to single digits. But mercifully, through the earnings season, despite whatever commentary the managements have been putting out, that number has held quite firm at 13%, at 13 to 14%. And we think that it will stay there because a large part of it is coming from, recovery in bank net interest margins, which I think, whatever the outcome of the Middle East conflict will largely hold up.
All right. So let's talk about, Seshadri, let's talk about the trends so far, and let's go step by step in terms of what is becoming clear. I mean, this is the first quarter in I don't know how many quarters that we've seen FMCG companies deliver. The results have been either in line or in many cases above estimates as well. What did you make of that? Autos is the other very, very strong side of the market. The numbers have been good. The sales, even for April, have been good. In these two pockets, what are your thoughts and, what are your preferences?
From macro perspective, neither of these two trends surprise us. Calendar 25 is a year of stimulus for India, consumption stimulus for India, both monetary and fiscal. It's rare that we get both monetary and fiscal stimulus at the same time. We had the GST cut and substantially, 125 basis points peak to trough rate cuts is not small. So from a macro perspective, it is not surprising that there is a recovery in overall consumption. And the numbers for consumer-facing businesses are starting to come through fairly strongly. If you dig deeper, we expected this to happen in autos. Autos has been our overweight for quite some time and continues to be one of the sectors that we significantly favor because we are in the middle of a multi-year run. I don't think this is a 1 or 2 year or a 3 or 1 or 2 quarter phenomenon where auto sales jump up and then normalize. FMCG, yes, has been to that extent a little bit of a surprise. FMCG does face other structural challenges because of the reworking of India's distribution architecture, where the traditional distributor-led offline architecture is being significantly challenged, especially by Q-commerce, and also barriers to entry from the democratization of access to advertising are coming down. So it is a bit of a surprise, but overall, the fact that consumption has been strong is completely in line with the macro events that happened in calendar 25.
Okay. What else, Seshadri? So far in the season, I think we are, probably 70% through it. What are the other key trends that stood out in terms of management commentary and numbers for you?
Well, the most important one, I think, is banks and financials. If you look at the lending companies, they need to tick the box in this kind of uncertainty and say, yes, if the West Asia crisis happens, we are making contingent provisions, etc. But on the ground, actually, there's been very little damage to the overall environment. The only negative that's come through for lending is that because of the pressure on the currency, domestic liquidity has not been as comfortable as it should have been in an easing environment, and you've seen that wholesale term deposit rates, etc., are under a little pressure. Apart from that little niggle, the lending environment is very positive. We ended in FY26 on a very strong note as far as growth is concerned. Expecting another strong year in FY27 on loan growth. And if once the war ends and the domestic liquidity improves a little bit, we will see significant improvement in margins for the large cap banks because of their high exposure to mortgages. And the commentary has been fairly strong across all the lending companies. So that would be one standout, I think, apart from what you mentioned, as far as commentary is concerned from the results.
Okay, so banks and financials, indeed, sector to look at. Seshadri, if I ask you about the way, your model portfolio perhaps would be looking like, considering that there is still uncertainty on this war, considering that oil prices are still elevated, what are you recommending to clients? Where should one be in this market? Because if you get the specific stocks and pockets right, I mean, a lot of money has been made. Before you joined us, we were just discussing Bharat Forge as an example. Within the defense pack, the stock has just moved from strength to strength, right? So there are pockets, but I guess they just have to be identified properly.
Correct. So, we're saying three things as far as, we have two things as far as our model portfolio is concerned. One is we are positioning for, a normalization. So 25% of our portfolio are stock picks which assume that the Iran conflict will end, the Straits of Hormuz will open, and oil prices normalize to $25. So we are significantly invested in the recovery trade, so to say, or the oil price normalization trade, so to say. And we have exposures like L&T, HPCL, Tata Motors, CV, to play that recovery delivery, 4 or 5 stocks that we have to play that recovery trade. The second thing that we continue to be overweight consumer, the Indian consumption. We are playing that through autos, and another favorite area of ours is the internet business. So we have significant exposures in quick commerce. So there are three things. One, we are, news flow will ebb and flow, but we do think that the end of the war will happen in the next weeks, coming weeks. And we are positioning ourselves for that. We continue to be bullish on discretionary consumption, and we are playing that through a significant overweight in the auto ecosystem. And overall consumption, we are positive. So internet is another area where we are significantly overweight.
Seshadri, you mentioned the recovery plays. And that included stocks like L&T, HPCL, and Tata Motors CV, right? If I caught that correctly?
Yeah.
Okay. So those are two clear themes. In financial, Seshadri, what are you right now backing? Banks or NBFCs and these capital market plays? When BSE came out with numbers just yesterday, numbers still looked pretty solid. So financials is a large universe. What is your order of preference and the stocks of preference there?
So our model portfolio, straddles the entire space. We have banks, NBFCs, and capital markets. So we are bullish on. Probably a slight preference for banks over NBFCs because this is the year when margins recover for the large banks. But it's only a slight preference. We do have some NBFC names in that portfolio as well. Capital markets is a theme that we are structurally bullish on, and we recently added another name, an AMC name to that portfolio. And so banks, NBFC, banks, capital markets, NBFCs in that order, I would say. But yeah, meaning our portfolio has presence of all three segments in our model portfolio.
So if I were to ask you, which would be the top, 3 or 4 stocks in your model portfolio, the biggest weights, the highest conviction, which would those names be?
We have Eternal. We have Eternal would be the standout where we have a really large position. We've been backing that for the last year and a half. We think that's a really strong long-term play as far as the quick commerce theme is concerned.
Okay, I'm just pulling up the longer term chart for Eternal. Trade stocks at 250. Yeah, so Eternal recovered to, well, didn't quite go back to the 300 level. And then it's been slipping. So, Seshadri, since you're so convinced about the internet plays, tell us a little more about what's the thesis. Is it riding on the belief that you think that as consolidation happens, it will be maybe this company that comes out on top? Because the naysayers are still saying a lot of competition and the discounts keep coming back. Regulation is forever evolving. But what makes you optimistic, and why Eternal in the platform world? I mean, there's Lenskart, there's so many other businesses as well, right? Urban Company, etc. So just expand on this theme a little bit.
So the way we look at internet is 3 or 4 things. One, we look at the TAM, and we look at how big the TAM is in the addressable market is concerned, and there quick commerce we think has a very large addressable market for fairly obvious reasons. Yes, there are 2 distinct stages of an internet company. The first is the land grab, and the second is the monetization phase. Quick commerce is still in the land grab phase, and yes, you are seeing emergent competition coming in every now and then. But we've seen the pattern play out in many internet sectors that the companies which establish an early lead, it is very difficult to dislodge them, and by and large, it does not happen. I can't remember, except recently 1 or 2 have happened, where an established leader then gets dislodged by a competitor after 2 or 3 years. It's the initial phase where the leaders get established. So while a lot of players are trying, my belief is that Eternal will survive that competition. Yes, we may be some time away from the monetization phase, but that does not worry me as long as I'm, the longer term growth outlook for the business is concerned. And there again, I think quick commerce is a structural play which is dislodging the traditional modes of distribution, and as it, and the proposition is very powerful for the consumer. So as it penetrates more and more cities, the business will overall continue to grow very aggressively. So that's my broad thesis on quick commerce, and that's the template that I use to analyze most internet companies. How big is the TAM? What is what are the things that make a company a leader or not? And then beyond the point, I really don't focus too much on whether it is in land. If it is in monetization stage, I don't focus too much on profitability in the short term, because once the market settles down, cash flows can be stupendous.
Absolutely. Okay, so that explains the conviction with which you're backing a stock like Eternal. Seshadri, sort of, come to final thoughts there, and this is sort of a broader question for investors. Now, it's very clear in the last month itself that this is a highly stock-specific market, while the index continues to be range-bound. Do you expect this trend to continue for the foreseeable future? Or do you think, because, I mean, you are actually, primed for recovery. You are expecting this war to end very quickly. So, at a headline level, do you expect an overall index move as well? Or do you think this will be ranging market, and you just try and look for individual stock ideas? And what's the advice, therefore, to viewers and investors?
No, we expect the broader market to rally very strongly once the war ends. If oil does go back to $80, because the rest of the economy is in fairly good shape. It's in very good shape, I would say. So we still haven't harvested the benefits of the consumption stimuluses that were given out last year. And once the pressures from the external sector start to abate, we will see that realized fairly quickly. And as you just pointed out, after many years, even FMCG is starting to show volume growth. That tells you the rude health in which the Indian consumer is in broadly. Yes, if this war extends for 6 months, then the entire thesis turns on its head. But I don't think that will happen. As I said, we are positioned that the war ends within a month or so. And if that does happen, then you will see a broader market performance, not just a stock-specific performances in a ranging market.
Okay. All right. Well, fingers crossed that the war really indeed ends and the market can fully and truly get its mojo back. Great conversation, Seshadri. Thanks very much for joining in. We look forward to more of these and probably reconnect with you once the earnings season is fully over. Thank you so much. Have a fantastic day and a good weekend.
You too. Thank you.
Thank you. All right. That's a view coming in from